afternoon and welcome. It's great to have your company. I'm Catherine Robson and I'm hosting today's Facebook live stream, sitting in for Alan Kohler, obviously, and I'm the host of Success Stories, the podcast that hopefully some of you have had the opportunity to listen to on The Constant Investor, and also the founder of Affinity Private. I'm a financial advisor and I have been for over 20 years. And so what we'll talk about today will be general advice in nature. So not taking into consideration your personal circumstances, but we've got some really great questions. So I might dive straight into them. So the first one comes from Richard, who's made more of a comment than a question. And so Richard's talking about the fact that he's decided to wind up his self-managed super fund and roll over into a public offer fund. And his comment is around the fact that he thinks he's picked the timing quite well because there is this speculation that's coming from the left side of politics around franking credits and how they may or may not be used in the pension environment, and whether actually you're better off to get someone to manage your retirement monies for you if you can find someone to do it at a reasonable price. I think Richard wanted to vent his spleen a little bit in terms of feeling like many retirees who have worked enormously hard to self-fund their own retirement and now find themselves in a situation where there have been a succession of changes to superannuation regulations, and that uncertainty undermines confidence in the system. But also I think there's some concern in regards to whether the alignment of interests is calibrated in the right spot, to the extent that you would expect governments to want to incentivise people to save for their own retirement. So there's some of Richard's points I really strongly agree with in terms of wanting there to be some certainty in the system. So obviously politics is about differentiation and both parties wanting to feel like they have different policies on certain issues. One of the things that in the debate around the refundable franking credits beyond a taxpayer's zero tax position, so the situation where you can't, in Labor's proposals, take your tax rate beyond zero and you won't get a cash refund if your tax rate goes beyond zero. One of the issues that I think we don't want to lose sight of in that debate is that superannuation remains a very attractive environment from a tax perspective. And these current rules, as they now are still more generous than the situation that we were in before the Howard and Costello changes of a bit over 10 years ago. So I certainly wouldn't want to see people throw the baby out with the bathwater and to ignore superannuation as an absolutely critical part of retirement funding. I do agree that it's horses for courses and that if you can find a good quality, low cost or a good value public offer fund, that they can be an excellent alternative, particularly when you price in the value of your own time. So one of the things about running a self-managed super fund is that you do need to be managing it. You do need to be making sure that you're keeping up with your compliance obligations, and that certainly does cost you in terms of your own input of time, even if you've got an accountant or someone doing the actual returns for you. So there are many good funds out there. I know Scott Pape, when he wrote his book, The Barefoot Investor, that was so popular last year, was talking very candidly and explicitly about some of the funds that he likes, particularly those industry funds that offer an index approach. So I think that's interesting that there's a broadening amongst industry funds in terms of the sorts of things you can invest in. And with My Super, cost is one of the things that certainly has been on the minds of both fund trustees but also fund members. So Richard, great to hear from you. The next question comes from James, and James is currently competing in a university competition and doing some work around company valuation and asking for some tips around what makes for good analysis. James referred this question to my brother, who was formerly an equity analyst and now is an investment specialist at Platinum Investment Management. And one of the things that I think anyone who's worked in equity analysis for a long time would agree on, that really understanding the fundamentals of a business is the critical place to start in terms of deciding whether a company is a good investment. And actually that's regardless of whether that company is an early stage company, is pre-listing, or is a company that's been listed on the exchange for a long time. So you can, I think, ask yourself from first principles, do I really understand what this business does? Could I break it down to its simplest terms and understand who its suppliers are, who its employees are, what its market penetration, market share is. So in the same way as you might be able to comfortably describe how, say, a newsagent or a milk bar operates, you need to be able to get to grips with how any business that you're trying to value, what the fundamentals are of that business. And that's the place to start. And don't start running your financial model until you've got a good handle on that, because what sort of business it is will then determine very strongly what's the right sort of analytical tool, and what sort of model is the right model to use to get an appropriate valuation. So, if you talk to a deep expert like I did when I referred this question to my brother this morning, the feedback is actually, if you've done the hard work and the common sense analysis at the beginning, the valuation bit is towards the end of the process and is the relatively easy part relative to actually getting your head around what the business actually does. So clearly some good resources to use, any of the analysis that you can find from brokers, for example, but then obviously the company generated information as well, the annual report. Some of those things are really good resources to be looking to draw on to get a sense of what the business really does. Duncan has a question in regards to valuation in markets, and I think this is something that has been exercising the minds of investors for quite some time. So the Australian market has been a bit lower than the highs it reached in January, and so Duncan's question is, should we be taking profits at this point? Should we be waiting to be buying stocks that are on our watch list as they come into good valuation territory, or hold off? And I suppose one of the things that's very difficult is to time the market. It's very challenging to be in a situation to accurately predict exactly which way the market is going to go in the very short term. So we've seen the market over the last few days trade significantly lower, and then last night have one of the strongest rebounds in several years. And so we are starting to see volatility re-emerge in Australian and global equity markets. It was very benign, as I'm sure many of you will appreciate, over an extended period of time. So if you look at the VIX index, which is generally a good barometer of what the expected volatility in markets will be, that was under 10 for quite some period of time. And so, to put that in context, during the global financial crisis, the VIX index got up to about 70. And so to have it down below 10 was well below historical averages. We're starting to see that volatility now spike up again, as we're seeing both intraday and multiple day variations and fluctuations in indices. Whether you should be buying stocks at current prices, again, I think goes back to thinking about what the composition of your portfolio is, what you're trying to achieve with those particular purchases. So, if you're looking to build a diversified portfolio that will last multiple generations, to be frank, it's probably not going to matter a huge amount, whether you buy today or buy, after a significant market correction if your holding time is long enough. Particularly with Australian stocks, which do tend to have that higher dividend payout ratio, so that dividend flow is providing you with a level of comfort. Alternatively, if your time horizon is much shorter and you're looking to be making relatively quick gains, not from the collection of dividends over time and the capital appreciation over time, but short-term trading opportunities, I'd be feeling pretty cautious at this point, thinking about what the global environment looks like. There still are a finely balanced set of considerations in terms of how markets are trading. So, on the one hand, we have this picture of coordinated growth amongst developed economies, which hasn't happened for quite a long time. The Japanese labour market is looking much stronger than it has for a long time. I think the Japanese labour market's only been this strong once since 1963. Europe is looking much better. Europe got through the election cycle, particularly the Italian elections recently, in a way that gives confidence that there's not going to be further fragmentation in Europe. So, and then the US economy is likely to continue to grow strongly, particularly with additional fiscal stimulus. So on the one hand, there's some things to be optimistic about. On the other hand, I think that there are certainly some challenges. There's the real risk that the US economy overheats, particularly with a very tight labour market and very significant tax cuts and expenditure stimulating an already pretty strongly growing economy. So the risk of inflation, the risk that interest rates, particularly in the US, rise much more quickly than expected. And then there's the geopolitical risks. So there are some really delicately poised relationships across the globe, any of which, as they tip over into things that concern investors, like trade wars, for example, can really spook markets. So I do think that if you're looking for short-term profits, it's clear that we're in the late stage of the cycle, and that's not to say that we might not see some very good returns. Sometimes there's the late cycle melt up where you see valuations and prices escalate towards the end of a bull market cycle. But equally, you couldn't see yourself in a situation where you get to the end of that bull market cycle and there's a major market correction. So I think caution is certainly something that's warranted in the current environment, and certainly a focus on where value lies and not feeling like you need to chase even good companies beyond where fair value lies. So we've got a question from Ganesh about the oil price. So the oil price is a key variable in so many stocks, well beyond the energy sector itself. It's a key variable in transport. It's a key variable in many production methods. And so we have seen an increase in the oil price. In the short term, the question is, does it remain at these levels, or are there factors that would see it spike considerably higher than it is now? One of the things, as the oil price moves from its current level towards where it had been prior to that correction a couple of years ago, is does a higher price bring on additional supply? And obviously supply doesn't come to market immediately. So if we're talking, fluctuations within a day-to-day basis, that's not going to be affected by lots of new supply hitting the market. But that's probably one of the things that puts a bit of a cap on where the oil price is likely to go, to the extent that if we do see a sustained higher oil price, it probably brings on some more shale production. And then that additional production then presumably has a moderating effect on spot prices. I think, in the longer term, certainly renewables are one of the things that, investors are keen to invest in, keen to see whether renewables can have a displacing effect on petroleum products. It's probably fair to say that it's a fair way down the track before we see solar and wind and other renewable technologies really make a meaningful impact on the oil price, just because the use of oil-based products in developed and developing economies really is so pervasive. So it's not just straight energy production that renewables will address. So probably we're likely to see the oil price remain somewhere around these levels for some time. The big caveat then obviously is that geopolitical situation. So if we saw aggravated conflict in the Middle East, for example, if we saw supply disruption from other key producers, then that is very likely to see a spike in the oil price. And so it certainly is not something that we would wish for in terms of there being, aggravated conflict. But that's certainly one of the things that needs to be taken into consideration when considering, whether oil or whether companies that are in the energy sector, whether they'll be good investments. I think as a side note, one of the interesting things is seeing the additional investment that's being made into capital works by the resources companies, and then the flow-on effect to those consulting and subsidiary businesses into the resource industry, because there was that prolonged period of very low oil prices. We did see underinvestment by many of the big resources companies for quite some time. And so it'll be interesting to watch the space around whether we're likely to see some additional investment that then makes some of those ancillary businesses that support the resource industry more attractive, with more contracts awarded and more activity. Sandra's asked the question about hybrids, and particularly the hybrids that are issued by the big Australian banks. Some of those have recently come to market, as you know, and some in the secondary market are trading below their face value. So, questioning whether some of those that were issued at $100 face value that are now trading at 99, 97, even lower dollars per unit, whether they make good buying. Hybrids, like fixed interest, are a reasonably technical area, and so you really need to look at each individual instrument, look at each term in terms of whether they're perpetual, whether they have a fixed end date, whether they're cumulative or not. So all of those things do factor into valuation, and so many of the brokers do have a good set of matrix around what issues are in the secondary market and their relative value, depending on their yield to maturity and what their current running yields look like. I think one of the interesting things will be, if a Labor government did come to office, it would have a big impact if that proposal around franking credits was implemented, to the extent that many of these hybrids are priced off the expectation of the full utilisation of franking credits. And so if that was no longer possible, I think it would make some of these hybrid instruments less attractive to some investors. So, that would be certainly something in terms of thinking about the bigger picture and the longer term, what the position would be under a Labor administration. Certainly as you see fixed interest instruments and hybrid instruments trade lower than their face value, assuming that they have a fixed coupon, obviously you're getting a higher yield as the purchase price reduces. And there will be instruments that will start to look very good value if you see them traded lower and you have confidence in the creditworthiness of the issuer, and depending on what your view of interest rates look like. So many of these hybrid securities are priced off the 90-day bank bill rate, and so if your expectation is that interest rates will rise, then you get the opportunity to have that floating instrument keep track with what interest rates are doing. So I think for me personally, I probably haven't been a huge fan of the hybrids over time, in terms of the risk-reward trade-off. I don't think there's been enough upside potential for hybrid investors relative to the risk that they're taking on. Particularly during the GFC, we had that experience of seeing some of these hybrid instruments really track the headstock in a way that didn't give them the defensive characteristics that you would want in a time of heightened anxiety in the market. The other thing is the experience during the global financial crisis really gave us pause in terms of the liquidity that was available. So where you have big lines of one particular hybrid as a core part of your fixed interest or defensive strategy, not being able to get your money out of that instrument relatively quickly, or needing to take a huge discount on the capital value of that, really does mean that, relative to other defensive strategies, you need to be looking for a materially higher return. So, from time to time, people have suggested to me that a hybrid is just like having a term deposit, but with a better interest rate. And in my mind, I think that's couldn't be further from the truth in terms of that risk return characteristic and the ability to be able to access your funds relatively quickly. So in terms of the next question, Michael's got a question in returns of whether low or mid caps that don't have a high PE ratio. So I think, Michael, I'll probably leave that question in terms of specific stocks. There's one of the big challenges in the small cap space is that you do often need to pay up for growth. And so where a company has significant growth trajectory, you find that the PE can really get to be very toppy. One of the other things, obviously, is PEs are relative to interest rates. So I think, sometimes when you're looking back at historical price earnings numbers, they're not always comparable in today's environment, given that inflation has been running at a very modest level, and therefore interest rates similarly have been low for a long period of time. But yeah, in terms of thinking about price earnings, that is certainly something to be aware of, and it's not the only measure, but certainly when you're looking at low and mid cap stocks, you do find that there's not much of a dividend return, and so thinking about the right sort of valuation technique, often PE is one of them where you do need to be sensitive to how much you're paying for that prospect of higher growth. So a question I like a lot from Barry, who said that he's enjoying the weekly female leaders catch up. So in terms of suggestions for future guests, Barry suggested that CEO, directors, chairman of listed entities, it could be something to do as an alternate each second week. So in terms of Barry's point, he's rightly referencing research that shows that female leaders in the US produce better results than male-dominated entities, and certainly having just had International Women's Day on the 8th of March this year, we've really had the opportunity to reflect on what some of the benefits of having diversity at a leadership level and throughout the workforce tends to look like. I think we're certainly seeing that from the US, but research from other parts of the world in terms of Nordic countries are demonstrating that diversity, not only gender diversity, but other diversity like age and ethnicity also really helps in terms of the quality of decision making, risk management, and overall return to investors. So that's a great suggestion, Barry, in terms of thinking about maybe alternating C-suite interviews on success stories and alternating that with women from other backgrounds. Duncan has a question in terms of the key factors for the US stock market in 2018 are well publicised, but wanting to know what we think are the top 3 macro factors that will provide tailwinds or headwinds for the ASX in 2018. So, I think, one of the challenges for Australia is to identify where will the growth come from. So clearly we had decades of resource-led economic activity, and that was largely replaced by a surge in building and construction that has started to tail off. One of the things that is not well publicised but is actually starting to happen is government-led infrastructure spending. Australia needs infrastructure investment. There's lots of research to suggest that productivity uplift is directly correlated with quality infrastructure enhancement, and so very positive about the fact that there is significant infrastructure spending, which really the business community has been calling for quite some time. So I think that will be one of the things that will be a tailwind for the economy. One of the flip sides to that is thinking about, well, where will jobs growth come from? So in terms of the unemployment rate, it's not terribly high, but certainly is not as low as we would like it. And there's just a diminishing return to labour as a proportion of total economic growth or GDP. And so, the concern is, where are the new jobs coming from? Part of what's happening is that jobs are being replaced by automation. Technology is displacing jobs that are repetitive in nature, and so seeing the replacement of those employment opportunities, seeing people being upskilled and have the sort of training and development that they need to either retrain in new industries or have new work entrants have the relevant skills to make them both valuable and well remunerated, will be, I think, one of the significant headwinds, not only for us as an economy, but for us as a community. And it's not only Australia that's facing that as a challenge, it certainly is something that in the developed world, many political leaders are struggling to come to grips with what you do in an environment where jobs growth is not readily demonstrable. So I think they're the things that when we look forward, we think about in terms of 2018 and beyond. We'd certainly like to see some strong political leadership into the future, both at a state and federal level, and probably for there to be some investment in rebuilding of the community's trust in big corporates. So the Banking Royal Commission, I think, is as much as anything a demonstration that the community has lost faith in some of the corporate leaders, and so a reinvestment in building that trust, and having a social licence to operate will be one of the things that will be on the minds of many corporates, well beyond those in the banking and superannuation industries. And so, I think we'll certainly see companies investing in some of those initiatives that might not necessarily drive profits on day one or even in the next 12 months, but that probably make them more sustainable into the future. So I think we might have got to the end of the questions that we've got. So terrific to spend some time with you this afternoon. Keep listening to success stories. It's an absolute pleasure to put them together. We love your feedback, so if there are suggestions for guests or suggestions in terms of the format, we'd love to hear them. We'd love to have your reviews on iTunes. This week's guest is Lisa Shallett. She's the Head of Wealth Management at Morgan Stanley Research globally. I had the opportunity to meet with her in person when I was in New York recently, and she has some terrific insights. And as someone who was on the front line in the epicentre of the global financial crisis, has some really key insights that investors can take away. So enjoy the rest of your day, and thanks for joining us.